Well, welcome to the Queens of the DMV. I am your co-host, Cher Castillo, and I'm here with Arnita Greene,
Hi.
our co-host, Arial Pegues.
Hey y'all.
And as always, you can check us out on Queens of the DMV on social media, on Instagram, and always check us out on Spotify, YouTube, and Apple Podcast. And today we have a special guest. We are talking about building wealth through apartment investing. So our special guest today is Tiffany Spann. Tiffany, welcome to the Queens of the DMV.
Thank you. So happy to be here.
Well, Tiffany, tell us a little bit about your background, and also how people can find you on social media.
Definitely. To give you a little bit of background, I'm from a small town called South Boston, Virginia. I'm sure most of you have never heard. Oh, you've heard of it? Okay. So yeah, from South Boston, Virginia. I came up to the DMV for college, and I've been here since. Where I'm from, I didn't even know that there was a such thing as real estate investing. I knew I wanted to do something and be someone one day, but I didn't know an investor was that. Um, I am the co-founder and managing partner of Crown Capital. It's a apartment investing firm. I have two partners, Noelle Parnell and Jared Ash. Noelle's actually out of Philly. Jared's in San Fran. We invest together in apartments. We're typically the general partner in our partnerships, meaning we're the active partner doing the day-to-day operations. And that's a little bit about the company and what I do.
Great. And how can people find you on social media?
On social media, you can check me out on IG, tiff.the.investor, Facebook, Tiffany Spann, as well as on LinkedIn, Tiffany Spann as well.
Awesome. So tell us a little bit about building wealth through apartment investing. Like, how does one get started?
All right. So I'll give you a little background on how I got started. I actually started off on the single family side doing single family rentals in Baltimore City. I knew I wanted to invest in apartments, but I was just like, how in the world are people getting these down payments for apartments?
Mhm.
So I started on the single family journey. My first place that I bought was a duplex. And after that, I was like, yeah, I'm definitely going to get a fourplex, sixplex, continue to scale up.
Yeah.
But I got the shiny object syndrome. Deals started coming my way, and they were good deals. So I'd say like every 2 months from like the beginning of 2019 to March of 2020, I was buying another investment property, but they were single family homes after the duplex. Then COVID hit in March of 2020. I also had a really shady contractor, and like my life was just kind of in shambles, personal life. So I was like, what am I doing? Like, why am I continuing on this path? Like, I need 100 of these in order to replace my consulting income that I had from a cybersecurity job. So I joined a coaching program, and that's where I learned how people were coming up with the down payment, like what they were doing, how Donald Trump was making his billions. So essentially, that's how I learned and got started. And once I joined the program, I was able to actually partner with folks in the program and really learn the ins and outs. I was taught how to underwrite. I had advisors in the program that were brokers, lenders. I really got the insider on it. My coach actually, like, he and his partner owns over 400 units together. And that doesn't really sound like that much, knowing like some of the folks that I know, but they individually own that, like not syndicated. So, I mean, to me, I'm really impressed by that, along with like a lot of the other coaches. But that's how I ended up getting started. I needed to understand like what the secret was. And the secret is syndication. It's pulling money together to invest together as a whole. But with syndications, it's actually twofold. There's general partners and there's limited partners. So in some deals, I'm actually a general partner, and in other deals, I'm a limited partner, meaning my partners and I own 134 units together. And then I also have another 764 units as a limited partner. So on the general partner side, you're going to have to like raise the funds, manage the property manager, deal with all the day-to-day insider stuff. Whereas on the limited partner, you just pretty much collect the check quarterly.
Okay.
Yeah.
And how do you decide?
which side you want to be on.
Mhm.
Well, you have to look at your long-term like game plan. So this is how I do it. On the general partner side, you actually get an acquisition fee when you close on a property. So the acquisition fee, you of course you're raising the capital for, but let's say you put down an EMD deposit, you're paying for due diligence, you have to pay for an SEC attorney because whenever you're raising capital, you have to bring an attorney in. And when you're doing these type of deals that are 12 million, $20 million deals, like you have to bring in an SEC attorney. So what was your question again?
How do you decide whether you're
Oh,
going to
a
be
general partner or a limited
right?
partner. Okay, yeah. So, I mean, if you're getting the deals, you're going to be a general partner. But if you don't even know about the deals, like it's really hard to get a deal. Brokers don't call you back. I was listening to your podcast about
Mhm.
the commercial side.
Yeah.
And so even with these deals, like we're building like relationships with these brokers. We're flying down to Atlanta for a day just to like go to lunch. You know what I'm saying? Like
Mhm.
just to like show like I'm so serious about this deal. So typically you'll probably start as a limited partner until you kind of break in, build the partnerships and relationships to become a
Mhm.
general partner. And even on my Houston deal, I'm able to be in on that deal through a partnership. Like my lender is on the deal, my property manager is on the deal, and they have combined experience of like 70 years.
Oh,
So, I
wow.
mean, the deal came to them and they brought the deal to us.
Okay. So on a typical deal, like, okay, so let's say you're the general partner and somebody would have brought you that deal. Now, and it's a $10 million deal. I know you probably can't, share all your training that you got and over coaching and everything, but just generally speaking, what does that look like as a new general partner, so to speak? Like with acquisition, do you have to get a loan? How much money do you have to put down?
Definitely. So if someone brings me a deal, they would get a percentage of the deal typically. And I mean, everyone structures deals differently, but like for bringing a deal, you typically can get around 20% of the deal. And then in terms of the down payment can go anywhere from like 20% onward. But right now it's around 25%. And like the loan that we have on the Houston property is a 311. So it's a 3-year interest only loan with 2 1-year options to extend it as an interest only loan.
Mhm.
So every partner has a percentage of the deal. Like with my partnership, I'm pretty much like the COO of our partnership. I'm really good with the systems. When it comes to like the investor relations and the marketing piece, I'm the one that's like setting up systems when it comes to like all the day-to-day functions. I have another partner. He's more of like acquisitions and asset management. And then the other partner, he's like investor relations. His background is in lobbying. I mean, he's raised millions of dollars. So essentially, when you're looking at a partnership such as that, like everybody gets like a certain percentage of the deal.
Mhm.
And even if you have like a key sponsor, because on the commercial side, if you get a $20 million loan, you need sponsors that are worth $20 million.
Right.
And like I told you about those key sponsors that have like 70 years of experience together, like there are key sponsors because we have like an $11 million loan and I'm not quite worth $11 million yet. So that's how it works. And then we have a very intricate like underwriting spreadsheet that we use. So I mean, essentially we can calculate our investor returns. One key thing about the commercial side, I mean, I feel like in real estate in general, you're already planning your exit strategy sometimes before you even get into the deal. So I mean, we always think about like multiple exit strategies. But yeah, that's how it is when someone brings the deal. But you have to act fast because it's definitely on the multifamily side. It's a seller's market as well.
So when you start, you really need to have a certain amount of money first to get involved. I mean, I know you're not using all of your money because you probably are doing it with a multitude of people,
Mhm.
but you should also have a set number, side money to, play.
So I would say yes and no. And the reason why I say yes and no is because there's some people that have nothing. Like one of my partners, he doesn't bring any money to the table. But we know like when the deals happen, like the money that I've spent, I'm getting
Mhm.
repaid. Because on
Okay.
some deals, I'm more of the money person, to be honest with you. Like I'm paying to set up the fund, I'm paying for like miscellaneous marketing costs. because it's like if they don't have the money, but they bring something else to the table, it doesn't matter because when we close on this property, we'll get an acquisition fee. Typically, your acquisition fee can be anywhere from like 1% to 5%, but it's around 3%. So on $10 million, when we close and we get 300,000, I'll get my money back and we'll split it up accordingly. So yeah, this is one industry where I feel like a lot of times you hear in real estate, oh, you don't need that much money to invest. You don't need. For me, when I was investing on the single family side and in duplexes and smaller stuff, I was always bringing money to the table. Was I refinancing and getting most of it back? Yes. But on this side of the game, I feel like you really don't have to bring money. If you can raise money, if you're like a real go-getter, you're pretty much raising the capital to invest in the deals. Like this is a making something out of nothing type of situation if you're a general partner. Now, if you're a limited partner, like some of the investors that I have, they're like, I love my job. Like, I don't want to leave. I just want supplemental income. So if that's you, like, that's a way of really, this is a way of really truly making passive income without adding to your responsibilities. Where, I mean, I haven't had something like this before ever. I thought that it was going to be like that on the single family side. But even when it comes to the property managers, it's like I have to manage them big time.
Okay. So on your Houston deal, like walk us through that a little bit, like numbers wise. Like what would, let's say, you know, I went to your Instagram page and I was like, ooh, Tiffany, I want to, you know, invest in that particular deal. What would I have had to do to be a limited partner on that deal?
Well, you can actually still be a limited partner on the deal. We're down to raising our last 100,000, so we dropped the minimum 25,000. But I'll just use $100,000 as a minimum investment. It's an accredited investor deal, meaning as an individual, you'd have to make over the past 2 years $200,000 a year, or as a couple $300,000 a year, or have a net worth of $1 million or more, not including your primary residence. Okay. And then on $100,000 investment, you'd actually get, in the end, an $85,000 return. So the way that it's broken out on this particular deal, it's a 12 pref, meaning you get a 12% preferred interest on your capital. So $100,000 on the 12 pref would be a minimally $12,000 a year.
Okay.
With this particular deal, you're not going to cash flow day one. Typically, when it comes to syndications, you don't cash flow until around the third quarter after closing. And when you do cash flow, it's typically quarterly. I've had deals that say monthly, but sometimes they'll like pull it back and say, all right, we're going to send out distributions quarterly. But let me go back to my Houston deal. So in the year one, you don't really cash flow that much. Year one, you cash flow around $2,800. Year two, you cash flow around like $6,000. But year three, at the end of year three, we actually have a refinance in there where you get 65% of your initial capital returned, in addition to all of the preferred returns. So the back pay. So that $12,000 from year one, the $12,000 from year two, and then the $12,000 from year three. So based upon those numbers alone, you almost have received back your entire initial investment by the end of year three. And then in years 4 and 5, you'll continue to cash flow on year 4, 12% preferred return. And then on year 5, you would actually get the profits from the sale. Because the cool thing about syndications, when you're an equity partner, you own a percentage of that property. So when the apartment building sells, you actually get profits from the sale. And that's where the money comes into play. And you're able to get that 85% return.
So projected on that, like at year 5, if you sell the Houston deal and I invested $100,000, what would I be getting back after the sale?
After the sale, I can actually pull up the underwriting. I wasn't expecting that question. But
well, it's intriguing. I'm just like
details. Yeah, definitely. I mean, in the end, you'll have an $85,000 profit, but I'll tell you exactly how much.
85,000 overall over the 5 years.
Exactly. Over the 5 years, it'll be a total of 85,000. Now, one thing that I will say is that this is a very conservative method of underwriting. Because with the multifamily side, there's a lot of value add techniques that we do. For example, water conservation programs, LED lighting. And I mean, sometimes you think like water conservation or LED lighting, like these programs actually save a whole lot of money. And we also are billing back certain utilities so that it's another way of making income. And on the multifamily side, the way in which it's evaluated is through the net operating income. So if you're able to actually raise the income and decrease the expenses, you're able to actually increase the value like drastically. And I mean, even through just the market itself, like the natural inflation that's happening right now, it's going up. Like on the Houston deal, the rents were already $343 on average per apartment below market value. So I've just pulled up my calculator so I can tell you what this looks like. So if we're able to get every apartment up to that like 343 market value rent, that's an extra income of $32,000 a month. And then for the year, it's $386,000. But then in terms of valuation, I would divide that by the cap rate, which the cap rate now down there is around like a little over 4%. But let's just say the cap rate goes to like 5%, or the value that's added to the property is actually, sorry. So I'm just have it on the screen there.
You got me writing down. This is good.
Yeah, because you're like able to actually let's see. Sorry, I gotta add the current value, but essentially you're able to raise the value of the complex by like several $1 million on such a small increase, you know?
Wow.
I mean, 343 is a lot, but I mean, it raises it a lot. Sorry, my calculator's freezing on me.
But the gist is you're at the end of 5 years, the minimum you're going to get is $85,000 for your $100,000 investment, but you're getting that $100,000 back plus the 85.
Exactly. And the cool thing is that as a general partner, you can be a limited partner and a general partner. So, I mean, not only are you making the acquisition fee, they also have an asset management fee. You could do both. So in Houston, I'm both. Like, because I'm like, I can double up my money as a limited partner because I mean, the underwriting is pretty conservative. So I'm pretty confident that we're going to make over $85,000 on $100,000 investment. So I say that to say, like, I invest on both sides of the deal. Or you could take your acquisition fee and roll it over and say, instead of paying me, put it onto the limited partner side. So let's just say I got $50,000 from the acquisition fee. I can throw it over onto the limited partner side and invest that in the deal on top of whatever else I invested. So that way the money's just compounding. And then we also get an asset management fee, which the asset management fee typically is around 3%, sometimes 2%, sometimes 1.5%. It just all depends on how you decide to underwrite the deal. But yeah, and that's like cash flow throughout the 5 years.
Are you finding better deals outside of the DMV area? Are you finding better deals outside of the DMV area?
Oh yeah, definitely. The first deal that I invested in was actually outside of Atlanta. This deal was at $54,000 a door, and I actually invested in it last June. Today it's worth $79,000 a door, and they haven't started any renovations. So that's a value of over $2 million in less than a year that has gone up. And that's pretty normal on the multifamily side. But once we actually execute the business plan, which the renovations just are beginning to start now, once we execute that, the per door price will be like a little bit over 85,000, which it'll probably go a little bit higher than that. The appraisal will probably come back a little higher.
I said I was already calculating that when you said when it went up just recently that fast. I was like, once that renovation is done, it's going to skyrocket.
Right.
Oh yeah, definitely. So I mean, the thing on the multifamily side, you could do a little bit and you could just add so much more value just because the way that it's evaluated, you know?
Yeah. So what guidance would you give to new investors that would have no experience that would like to get started?
I would say to invest as a limited partner first to just kind of understand the ins and outs. I mean, I invest as limited partners on deals to understand what they're doing because there's so many different strategies. Like we're adding Amazon drop boxes. It's another form of income. Like what are they doing to be more efficient, operate, better than what I'm doing? Even if you don't even want to become a general partner, and just learn, I think the best way of learning sometimes is kind of to jump in and do it. And maybe that's just my investing technique, but it's something where I'm really bullish about this particular investment just because there's a solid asset behind it. And even when there's been crashes on the single family side and in the stock market, one thing that stayed consistent is apartment investing.
Exactly.
Yeah. But I would say invest, listen to podcasts, read books. That's what I was doing. I was kind of self-teaching myself. But then once I got in that program, it just gave me a PhD in apartment investing. And it's if someone asks a question or needs something and I don't know it, I have hundreds of people I can tap into. I was I almost had a limited belief when it came to investing in apartments because I didn't know that there were people out there who had 10,000 units that they were managing, being the GP on, I didn't know that was even possible. And even Joe Fairless that I met last week at the conference, I've been following him for a long time. And just to see the way that he's gone from 500 million to 1.98 billion over, a 3-year period. And he's 37, 36. It's just to me really crazy. And then talking to him and being around these people, I'm you're no different from myself, there's no difference,
Definitely. What are your biggest do's and don'ts with investing?
So I would say I have a lot of friends who I know are sitting on money and they're I just can't do it. I don't have money to put on ice. But then I'm your money's been on ice in the bank.
Exactly.
And I know you're making money. I know you're making money. We are in PG County. I don't know. And we're in the DMV. I'm in PG. I'm sorry. But my friends, and I'm just what do you mean you don't have the money? It's been sitting on ice already for years. It's not making a return. And I'm start somewhere. And I think that it's even with myself, I looked at houses before I invested for 18 months. What happened in 18 months was just crazy. And when I started investing, I'm man, if I had invested then, look where I would be now. And even now when I'm starting to sell off some of my single families, I'm just this is outrageous. I can't even believe they're paying these prices, I'm take it, whatever. Okay. But I say that to say, I'm just start, it's one of those things that my coach he told me, he said, Tiffany is very forgiving. One thing about this industry is forgiving. If you mess up in 3 to 5 years, it's gonna be okay. You know what I'm saying? It's gonna come back around because I even have a girlfriend and she was telling me about a deal that she just did, and she didn't just do it, but it was 1.5 years ago. But it's just a JV. So it was just some folks come together, 6 of them that came together, bought an 18 unit down in Miami. And she's talking about it. But when you talk to her, she's she's just not doing it. She's not doing it. But I'm I'm doing the math and she's telling me what they've done. And I'm wait a minute, you've added $2.5 million worth of value from what I'm just listening to, with these little bumps and increases in rent. But I say that to say, just get started, start building that wealth, just get started. Don't be afraid to invest because you're not going to get wealthy off a W-2 job. You're not going to get wealthy without investing. When you're trading hours for dollars, there's no way, even if you're working 24 hours in a day, to get there.
Yeah. I think a lot of people think that it's so different. It's only a couple of ways to win or to, get money. And even hearing this side of it and you diving in even more into it. It's just I think we just don't know all of the avenues to acquire wealth. And there are so many other avenues to acquire wealth.
Definitely. And I didn't realize that this was even a thing. Had I known that I could have invested in apartments when I first started, I would be at a whole different place right now. I even have a young lady I was talking to, and she started investing when I started investing in single family. She started investing in apartments. She retired. She was look, she took her money from her job because with this is there is different ways of investing. But anyways, she took some money that she had cashed out from her job and she invested. And basically, she's 36 and she just retired. And she was like, "Look, I'll bet on myself. In 3 years, if I'm not doing anything, then I know that I can go back to work. That ain't going nowhere. But yeah." Had I known, I'd be in a totally different place right now, because I put a lot of money into like single families that I'm slowly like starting to get out. But had I known that this was actually an avenue where I could invest, I would have.
Yeah.
Oh, go ahead.
Oh no, I was saying I'm glad you brought up the sitting on money thing, because that is like, it was one of my questions that I had for you, because you do have to, if you're, whether it's 25 or 100 or however much you're investing, you do have to kind of think of it like, I can't touch it for the next 5 years, right?
Right. But I think that it's looking at money in a different way. Personally, my money is like a bank. Like, I continuously rotate it. Like, when I'm taking money from an index fund, I'm moving it over here to invest in an apartment. I'm moving it back up. Like, it's always making money and I'm shifting it. So I think it's like the way in which we look at money. Like, if you have money that you're going to have to touch to invest, like, you probably shouldn't invest. Like, get your money up a little bit more before you get into this. Maybe like figuring out a way of, being a general partner, or ways in which you can like get into the deal without being an LP. For example, I have another buddy and he's like, "Tiffany, if you ever need help closing, call me." Like, what he'll do is, I even had this happen on the Houston deal. Another buddy, "All right, I need $250,000 to close." He's like, "All right, I got you. But what did I have to do in return? Give a percentage of the deal." But when we close, I'm like, "Boom, here's your 250. I gotta," you know what I mean? Like, you got a percentage of the deal. It's just a way of like resolving problems. And I think that like in real estate, that's all we're doing every single day is, resolving a problem. And that's one way of looking at it too. Like, you could start doing this and getting a percentage of a lot of like smaller percentages of a whole lot of little deals and turn your money quicker. Or you could say, "I'm gonna be the hard money lender. Here goes 250, give me back X percentage." You know what I'm saying? And I'm like, look, because one cool thing about this is like, I can raise the money to pay back my investors for the first year. So when I can like watch what's going on with construction, make sure everything is going swimmingly with the property manager or whatever, you know what I mean? Like, I kind of have a bit of a buffer before I'm like, "Oh, what am I going to do?" Like, we have a lot of reserves sitting. So, I mean, there's a lot of different ways of cutting into a deal. And if like not being able to touch the money is an issue, it's like thinking, how can I break into the game and still be able to touch my money?
Mm-hmm.
And I mean, another thing is like to think about is like the taxes, like a cool thing about multifamily is like cost segregation studies and the bonus depreciation. And like, even on the Houston deal, we're waiting for the cost segregation study to come back. So it may come back so that we can depreciate 70% of the value of the apartment building. So if you invested $100,000, you can pretty much write off $70,000 on this apartment, But if you're not a real estate professional, you can only write it off towards your passive income. But if you are a real estate professional, you can write it off towards your active income. So it's a way of truly making money without having to pay taxes. And let's say you don't use all of that depreciation. What you do is you roll it over to the next year and you can use it the next year. So, I mean, like me, I'm always playing around with, I'm not saying playing around, because the tax laws were kind of like built to tailor and help people who invest in real estate. But I may do a 1031 exchange to defer the interest and then invest into an apartment building where I'm getting passive income and then, depreciating it. Like, it's a lot that goes into it, but it's like long-term planning. And it's like, even when, Hillary Clinton said that Donald Trump wasn't paying taxes, but it's kind of like, well, if you can make, this money without paying taxes, then would you do it? And it's not like you're doing anything illegal. You're doing what the law tells you to do.
Right.
Yeah.
So I'm down for that plan.
I know, right? You're an active like real estate professional, it's something to even think about, because I actually have a girlfriend, and her husband, they're both considered real estate professionals. And she's like, "Yeah, we got to get in on an LP deal. We got to get in because it's like they're able to write off, much of their income." And I mean, for them, it doesn't really matter because they have cash. They're not going to, I mean, they're just like in a different, you're in a whole different position when you're doing those things.
Right.
So it's like, it's constantly planning and, executing off of that. But yeah.
That's awesome.
Mm-hmm.
I love it. I love it. I love it.
So with your Houston deal, and you said you're still raising capital for that.
Mm-hmm.
And I think I saw on your social media, you lowered the entry price to $25,000.
Right.
So on a $25,000 entry price, what do the numbers look like?
So you'll still get, still a 1.85 multiple equity multiple. So essentially off of 25,000 in the end, you have around $46,000. So what's that? It's not quite doubling, but it is 85% return. So I mean, after 25,000, you'll see 46,000 in the end. I mean, in order to hit big, you got to play big too. But to be honest with you, if you're starting off with 25,000, I feel like where else are you going to get those returns? I know personally in the stock market over like the past 3 or 4 weeks, I've lost $17,000. So I'm thinking to myself, even though I'm not at a loss right now, I think to myself, I could have moved that over, that 17,000 with some other money and invested, on the apartment side. I wouldn't have had to think about this,
Exactly.
But I say that to say it's like people are like, they want to be in control of their money, but just because you're logging into Vanguard or E-Trade and you see your money, like you're still not touching that money. And when you do decide to cash out, guess what you're doing? You're paying taxes on that money. You can't 1031 exchange it into anything. You can't move it around. Even now, like I have something called an EQRP, kind of similar to a self-directed 401k. But if you're a business owner, you can have one of these and you can contribute up to $58,000 a year to your retirement. So what I've been doing is maxing out on my EQRP every year. And I've been W-2 employee in prior years where I'm maxing out on both sides. So I mean, 19,500 plus whatever the EQRP. So essentially like almost like 70,000 or something. But I mean, I'll use that money and then invest it all into different deals. But then I'm getting a relationship with people that are doing $1 billion in business. You know what I'm saying? That I get to talk to whenever I want to. Not that I'm like blowing them up. I'm also learning, making money at the same time. It's like a win-win for all, and they're giving me secrets. I mean, with Joe Fairless, and he's telling me things. I'm like, you doing this? I'm like, you getting your money back? Like, it's a lot of different things where you can move around money where I'm like, man, you mean you still getting your money back? You doing that, you doing that, you doing that. But it's like you can only do that if you get checking the game. If you don't check in the game, you're not gonna be able to do it.
You are sharing so many good things today. Like I can't keep up.
I mean, I'm so passionate about it. Like I love this.
You can definitely tell how passionate she is about it, and I think that what makes me love her even more because how passionate. I'm over here writing everything you're saying.
Yeah.
Yeah, I mean, it's just like a total game changer. Like when you start looking at the numbers, like what little rent bumps do and what, like the incentives that it have. And like what's exciting about this to me too is like sharing it with other people. You know what I mean? Like I even give an example to one of my buddies. Owns how sometimes you end up with a rental property that wasn't really intended, like you get married or something and then y'all move into your spouse's property or whatever, like you just move on and you're like, I'll just rent this out. I know they sitting on a whole lot of equity. And I just was like, look, bro, if you pull 250 out, invest in this deal, I mean, it's conservatively underwritten. In 3 to 5 years, you're going to have 500,000. Then you take that and you move it into another deal. It's sitting right now. That's money that's sitting. People don't think about it. You got resources sitting all around. Like I'm always like looking and thinking like, how can I leverage what I have? That's why I say I'm my own bank. I'm like, look, if I need something, I'm going to sell this. I'm going to refi this. I'm going to move it around and I'm going to make more money from my own money. You know what I'm saying? And I'm looking at him, I'm like, bro, you can make $1 million in 8 to 10 years with not even like doing nothing. But you don't want to like pull your equity out and try. And you got a renter in here that's going to pay anyways your mortgage. Like, why wouldn't you take this chance and this opportunity? You know what I'm saying? So I look at that a lot of times and I'm just like, I can't let my money sit like that, And I just think about like when I look at my son, I'm like, he's the boss, like I can't see him over here like, having to work the way that I've had to work and like do the things that I had to do. And I'm just like, it's something that's like you can hand down generations to come, not only, for him or like my son, but I mean, he's going to be able to hand that down too, Because
Yeah.
this is something that's like black and white.
Well, let me play devil's advocate because I'm really good at doing that. So, and I see that you're a full-fledged risk taker, and so am I. So I'm not even. I'm just playing devil's advocate for the audience because I totally believe in using other people's money to make money or leveraging, equity from properties or wherever else to invest in other deals. So I'm totally with you. However, what about for those conservative investors that are thinking about getting started? What can they like? How can you ease their nerves? And what I mean by that is, what if they're like, "Oh, well, the real estate market is, it's the crash is coming. Everybody keeps talking about the crash. It's coming. The crash is coming." How's the crash going to affect the apartment market?
Okay, so I think that it's understanding the valuation of apartments versus the valuations of single family homes. So when it comes to apartments, it's not valuated the same way. I can't say, you see that apartment building over there and your apartment building, this is why I got this value. It's not like that. Like you can have an apartment building, I can have an apartment building, and we can run it two different ways, And the way that I'm running it is way more efficient than what you're running it. And I'm increasing rents every single year. Prime example, I just sold a duplex and I wasn't even thinking about raising the rents. I'm like, I'm gonna put this Section 8, I'm on cruise control. I bought right, I'm chilling. Like, I don't even care. Like, give me my 2% increase. Dude came behind me that I sold it to. He's like, oh my gosh, like it's $300 more you can get. Like, I'm talking to the city council already and getting all, I'm like, cool. I say like, he's able to like get more value and more meat on the bone on that particular deal and increase the value. On a duplex, you really can't. But I mean, on the multifamily side, you can. Like, all you have to do is bring that net operating income up, and then your valuation is completely different. So that's one thing that I would say. And then the second thing that I would say is that many times those people will spend money on different things. And I say that like they'll spend money on a depreciating asset and want to buy a depreciating asset in cash versus leveraging what they actually have. And I mean, I would probably just give them like case studies. And I do that already to friends and family and just talking to them, like, instead of putting the money here, you could be putting it here and making this much money. But I mean, honestly, I feel like it's opening up your vision and not having like limiting beliefs,
So are there any situations where you may put, 25, 50,000 in and never get it back?
Of course. I mean, there's people who are just like scammers, period. One of my mentors, she actually had a partner that took $750,000 that they had raised, and her and her husband had to go to the husband's mom, and pretty much they took out a line of credit against their house to pay back the investors. Joe Fairless, I was talking to him at the conference on his first deal. He lost his investors' money. He had 12 investors, over $1 million. But what did he do? He worked and paid them back. And I mean, I think that that's a key thing. Is like working with people that it's an integrity factor. My thing is like, I'm not going to take anyone else's money on this level and not be able to pay them back. I'm on the single family side. I was just kind of like, I'm not going to say like really risky, but I just knew like, all right, I'll pay you back cash for, you know what I'm saying? Like I could really like cash out on the single family side, but on the multifamily side, I'm like, I can't like cash out this much money. So I say it's like, I'm very like particular on my deals. And when I'm taking someone's money, I'm not going to sit over here and do it if I don't believe in the business plan, And even on the Houston deal, we had an investor like fly down, my buddy that we're raising money together. And I mean, we walked the property and talking to him about like, this is why this business plan is going to work. And what we did is take him to other properties and say, well, you see this, and that, like, this is why this is working with our property. You know what I mean? And I mean, I just say that to say it's like having a sponsor / operator / general partner who has good integrity that you can touch. I don't want to give somebody my money and then it's a black hole. Like I've done that a few times before with contractors, marketing folks, like different folks. Like if I send you my money, like I want to be able to touch you. So it's like, I think that those are things that you have to like evaluate, and you need to, even before you even give someone your money, like start talking to them, meeting with them. Let me see what you got going on. What's your returns look like? Because it's like, if you're not doing it, guess what? I'm not doing it. I'm invested in the Houston deal. I'm invested in all my deals. You know, I feel bullish about it, you know?
So you have skin in the game and you're in all
Oh, yeah. Skin in the game always. And I mean, I know you're like, you like to take risks like me. But it's like, I'm a very conservative risk taker, you know, because I have lost money on multiple occasions. And now it's like, I think to myself, I have very little room for error. So when I'm looking at deals and underwriting things and the people that I'm partnering with, I'm very precautious in what I'm doing, because I mean, I'm a single mom, and I just think about like, I can't, I can't lose this. I've gone too far, you know, and I can't lose it for everyone else too, because I mean, it brings me joy to bring other people money.
That's what I was going to ask you, Tiffany. Like, how do you decide who you're going to invest with, or what deals you're going to go into with another individual? Because I think people don't know how to pick partners in situations.
Really, really good question. So one thing is like personality tests. For example, I'm a visionary. I mean, a visionary and I could partner together, but who's going to do the integrating? You know what I'm saying? So it's like, I need integrators. Like when I said I'm the COO, like I'll come up with systems, coming up with a vision, but it's like my partners, a lot of days, they're integrating. They're hitting the phones with the brokers. I mean, my one partner, I mean, he just came back from Nashville meeting with the broker, because it's like, he's the integrator, you know, like I'm the visionary. I'm pretty much painting the picture, you know? So you have to know like where your strengths and weaknesses lie. And both of us are good at the same thing. I mean, not to sound bad, we don't really need each other. And one thing I look at is like, how can I help you and you can help me? Even when it comes to friendships and everything, I'm like, I don't want this to be one-sided. And it's not like, I don't want, you know, someone helping me, but if I can't help them too, then it's like, it's just no fun, you know? I want someone to complement my strengths, and, you know, where I'm weak, they need to be strong. So I say that to say, it's like, that's what I look at when it comes to partnerships. I look at past performance. I look at references. I look at just, I mean, the past performance alone is the track record, you know? I mean, even today I'm looking at things. I go and look at land records. I'm looking at what's going on, you know, the history of things. You could tell me one thing, but I'm still looking it up. I'm Inspector Gadget with it. Right. I'm gonna go to every page, IG, Facebook, Twitter, whatever. I'm doing all my research. You know what I'm saying?
You want to know who you're working with.
Oh yeah, for sure. You know, and I think that that's something that's like so important. And I think that I didn't realize that until I got into this game. When I was on the single family side, I feel like I could just be under a rock my whole life. But when I got into the multifamily side, I learned that is not the case. You need to get out there. You need to talk to people. You need to let them know, like, if you need me, I'm here, you know? And I think that that's key. Even on the deals that I'm a LP in, like I'll hit up the GP and say, hey, let's meet, or, you know, get some time on their Calendly. Like, I'm not going to always hit them up constantly, because I know that it's like a long-term play, but I am going to be able to like touch them and pick their brain and talk to them. It's not like, oh, it's an issue with it. It's like, no, if you invest 25, 50, 100, whatever you're investing, you deserve somebody on the other end talking to you. If I want to go and walk the property, whatever it is, it's like, to me, I'm here to serve you. And when I'm looking for someone to invest with, I want them to want to serve me, to want to help me. I mean, one thing that I have found on the multifamily side is that people are more apt to like tell you the secret sauce, to tell you what's going on. I mean, they have more of an abundance mentality, because it's like so much money out there. And I didn't know that there was so much money out there until I started doing this. And I'm like, you did what? You raised $30 million in 2020 during a pandemic. You did this, you know what I'm saying? Where it's like, they're telling me the secret sauce. They're telling me the systems. I mean, I even joined a program to set up an automated platform where it's like automating everything for me. But I mean, they're willing to give me the secret sauce. But I mean, I think the key is that a lot of people just don't execute on that secret sauce. They can have the secret sauce, but they can't make it the way that KFC makes it. You know what I'm saying? It may be Popeyes with it. We KFC. y'all Popeyes up here.
Well, so what you're telling us is that we should all invest with Crown Capital, and you can make us very rich, Tiffany.
We definitely need a mentor.
I'm not going to make you make you wealthy.
Oh, I'm sorry. Correction. That's awesome. Well, thank you so much for taking the time to talk to the queens of the DMV today. And I'm sure we'll all be individually following up with you for next steps, along with hopefully our audience as well.
Oh yeah, definitely. Feel free to hit me up. I'll walk you through underwriting or walk you through some of the questions that I couldn't answer. My calculator had kind of frozen up on me. But if you do have any questions, feel free to reach out. I love what I do. I'm also I have a women's meetup group, and I mean, I just love working with women. I just feel like it's so much easier to like talk to you and just,
Yeah.
share the knowledge and ask questions and really learn and grow together.
Well, that's awesome, especially since it's International Women's Month. Is that it? Did I get that right? Or Women's History Month?
History Month, but I think today is like
Today is International. Yeah.
International Women's Day.
Yeah, absolutely. So cheers to us.
Definitely.
All right. Well, thanks again. And we're signing off on the Queens of the DMV. I'm one of your co-hosts, Cher Castillo, signing off with Arnita Greene and Arial Pegues. Thanks again.